When we look at income stocks, they're also many times known as dividend stocks because they're paying a dividend. Income stocks, really the idea behind them is they're going to pay you money. They're going to pay you a dividend. They're going to pay you income. So if I own the stock, just by holding it, they're going to basically pay me, typically on a quarterly basis, a stream of income based on a dividend. And that's a great thing, right? I just buy the stock, I own it, and they give me money. What a wonderful world, right? And that's one reason that dividend stocks or income stocks are very, very popular. They won't grow as fast as far as their capital appreciation, your price, what you paid for it, and what you can potentially sell it for. It won't grow as fast as, let's say, a growth stock. That's the idea of growth stocks, is that capital appreciation. But growth stocks are not paying that dividend. They're using anything they could pay in a dividend to finance their operations and continue to invest in their company. Where an income stock might not grow as much as far as the capital, the price of the stock, but it's going to grow by giving you dividends and then growing those dividends and consistently paying those dividends. So they're a great way to get current income in there from income and dividend producing stocks. They're great for like retirees. Is a very common way. It was always the traditional way that retirees would have a basket of like bonds and cash and then maybe some dividend stocks. Now that people are living longer, you're actually seeing retirees with more growth stocks in addition to income stocks in their portfolios because they're living a longer period of time, which is terrific for all of us, hopefully. So retirees are depending on that income, so they own these growth stocks, they get a little price appreciation, but then they're getting that quarterly check that they use then to, finance their life, go on vacation, buy things, groceries, whatever it might be, or continue to invest. So they're great for retirees. They're also great in a low interest environment. And why is that? We've been in a period of very low, record low interest rates for a long period of time. When you have low interest rates, when people buy things or invest in things like treasury bonds or cash or other types of bonds, government bonds, corporate bonds, the interest rates are low, right? That's the low interest rate environment. So people are not getting the return they're looking from those low interest rates on things like bonds and cash. So they're looking for alternative ways to get income coming in, maybe at a better rate with maybe some capital appreciation. And that's where dividend stocks come in. It's like if I'm going to get only 2% or 1% of my cash, why not take that cash and invest in a dividend stock that might be paying me 2 or 3% in dividends or dividend in yield. So I'm going to get 2 or 3%, and then I might have the stock go up over time. Like, that seems almost like a no-brainer in a lot of ways. Now, the stock could go down. They could cut the dividend. There's more risk. We get that. But that's one reason people like dividend stocks in a low interest rate environment. By the same token, it can be risky, or it's less popular in a very high interest rate environment because you can get your return or that income from other sources than stocks or dividend paying stocks. So be wary if we're in a low interest environment and it rises quickly, that might impact or hurt dividend paying stocks. But low interest rate environment, they're great. Also, they're great for more risk adverse investors. People who don't like that volatility, the stock continually going up and down. Now, dividend stocks can go up and down. Sometimes they can go up and down in big swings, but the idea is they don't. They're more those large long-term companies, steady eddies who always pay a dividend. That's kind of what you're looking for. And they're just steady, good companies versus maybe a growth stock that might be a great payoff in the future, but it might be real volatile in the near term, and maybe it never takes off and it just becomes a dog and hurts you overall, and you got to sell it at a loss. So if you're looking for something that's less risky than a growth stock, then look at these income or dividend stocks. They're typically large cap stocks because these are big companies that are then paying a dividend. And so you'll find them typically in large cap. You can find some small, mid cap, but rare. It's mostly all the large cap brand names, like Coke and Exxon and all that. You're looking for consistent dividend payouts too as well. Sometimes companies get in trouble or they struggle to make their dividend payouts and they might cut their dividend or eliminate their dividend. When that happens, you get less income coming in, which hurts you. But also by them doing that, their actual stock price goes plummeting because people are investing in those companies because they want the dividends. So dividend paying stocks try not to ever cut their dividend if they don't have to. It happened, especially in like 2008, 2009 during the Great Recession, that many really good companies cut their dividend. It really impacted them overall. So be aware of that and look for those companies that pay these consistent dividends out over many years, 5, 10, well, more than 5 or 10, think 10 or more years, 20 years. There are some that pay even much longer than that, and those are great consistent dividend paying stocks. Okay, so let's look at some tips around income paying or dividend stocks. One is look for companies that are very stable. Not only are they stable as a company, but their industry is stable as well. I mean, you could be a stable company, but in a real screwed up or volatile industry, that's going to affect them negatively. So look for good, solid, stable companies that have been growing and doing great for a long time and paying those dividends for a long time, and maybe in a real stable, normal type of industry versus something, crazy or wacky that's more of a growth industry. So stable companies, stable industry that can pay those consistent dividends. Use the same fundamental analysis and ratios and things to evaluate, dividend paying stocks like you would any stock. But there's a couple of them you want to key in on for income and dividend paying stocks in particular and really look closely at. One is the dividend yield. You might see it when you look at quotes and things, you'll see dividend yield, and we talk about this later in the ratio section. But, dividend yield, which is basically looking at if I buy that stock and it's going to pay me a dividend, it's going to pay me income, what is the percentage on that? What in effect interest rate might be a way to look at, is it equivalent to? So if I've got cash paying me 1% and the dividend yield on a company is 2%, well, I'm making more money just on the yield, or I'm making more money just on the payments they're sending me, just like interest on a cash account, or savings account, they're paying me cash directly in the form of dividends and at a rate of 2%. So I can then compare them. Now remember, they can raise or lower dividends at any time, so it's more risky than something you might lock into like a CD or a treasury note or something like that in terms of cash. So they're going to pay that income, then you can look at the yield. You also want to look at the dividend growth rate, which means not that the stock is growing, hopefully it does that, the stock price appreciates or capital appreciation, but you want the dividend to grow as well, what they're actually paying you, and they do over time, some more than others. So it's not a consistent flat rate that you own forever. The dividends will grow each year as well, some faster than others. So a good growth rate will not only, it'll kind of give you that great double whammy, you get that consistent income each quarter, but then every year it goes up a little bit more, so then that following year you get a little bit more. And the year after that you get a little bit more, and then a little bit more. So after 10, 15 years maybe of holding a dividend stock, what you paid, you're getting a lot more income than you did originally. And isn't that a good thing? It's appreciating. You're looking for those consistent dividends, of course, so look at their dividend payout history. You see if they've, a lot of companies will tout that we've paid a dividend for 20 straight years or 30 straight years or whatever. So look for those types of things, maybe an annual report or looking at, history of dividend payouts, so you can search for that and see that they're consistently paying that dividend. And then the last thing that's a little bit of sneaky number, but real important, that gets missed a lot, is the dividend payout ratio. And compare it with its peers in the industry, overall market too, but really look at the peers in the industry. And what that ratio means is it's looking at the earnings or the cash that is coming in a period and how much of that is getting paid out in dividends, right? They can take all those earnings once all their assets, all their expenses are done, their revenue, their sales, they have their expenses, whatever's left over is their income. How much of that is getting paid out in the form of dividends? And then how much is going used to invest in other things in the company or finance other operations? The reason the payout ratio is important is if companies are struggling and they're either losing money in a period or a period of time, or they're struggling to make ends meet, well, one thing that they could cut is dividends. Remember, that's free money that's basically coming out to you. If they cut or eliminate their dividend, that's money they're now keeping in the company, and then they can then use it to right the ship or invest in themselves. Now, companies that pay dividends hate to do that, because if they reduce or cut the dividend, everybody who bought into that company looking for dividends immediately runs out the door and their stock price just goes plummeting. So they really don't like to cut dividends, which is good for you and me. So the payout ratio is showing that percentage of their income they're paying out in dividends, and you want that number to be as low as possible. So if it's, like, say, anywhere from 0%, of course, would be, well, not 0%, but let's say 50 to 70% of their income, if they're paying out in dividends as a dividend-paying stock, that's pretty good. More towards the 50, 60 range is good. Sure, they're paying out half or a little more in dividends. That's okay. That's what they're there for. They're a dividend-paying company. They're focused on that. A lot of utilities will pay much more than that. For example, like, oil or gas or electric companies will pay more than that. And that's okay. Just look at how their industry peers are doing. If you start getting about 70% in payout, that's a lot going out. That's even a little more concerning, especially if you start getting the 80% plus. of income coming in is going right out in the form of dividends, well, that makes it real hard to withstand a shock to the system or a bump in the road or a decrease in sales or something that happens. They're really living on the edge then. So if you're investing in companies, watch out for any that are paying 80% or more in particular in the payout ratio. And really, if you're in a volatile industry, or looking at different stocks in a volatile industry, those ones that have a lower payout ratio can be better. Even if they're paying out less in yield, it might be a better investment because it's going to be more consistent and more safe. So that's something to consider as well. So there's lots of companies that pay out dividends. Let's take a look at some examples here. And there are really a lot of them are household names, right? They're the products you might use every day are these big, long-term, Fortune 500 large international companies that pay out these dividends. And some may pay out for a long period of time. I've got an example here. A long time paying dividend stock is Johnson & Johnson. They make Band-Aids and they do medical equipment. They do things related in the health industry. Things that you might even be buying yourself in the grocery store every day or in the market related to health type things. Johnson & Johnson is really involved with that. So with Johnson & Johnson, they've been around, 50, 60, 70, 80 years, a long time. And they've been paying out dividends consistently for the last 53 years and have been growing those dividends every year for 53 years. I mean, think about how consistent that is, that they've been growing dividends for 53 years. And they were founded in 1886 and they've been paying out dividends for 100 years. So in 100 years and more now, they have been paying out a dividend. In the last 53 years, every year in the last 53, they've grew their dividends so they pay a little bit more each year on that dividend. What a great consistent company. And their payout ratio tends to typically be around 50%. So it's a very popular stock as far as people want that consistent dividends. Now, there's no guarantees, and Johnson & Johnson gets sued all the time, by the way, because they're involved in medical devices, pharmaceuticals, a lot of things that can lead to problems or issues if something goes wrong. So be aware of that. Their stock price could drop anytime, their income could drop anytime. But if you're looking for somebody who's at least has a proven track record, well, there's a good example of one, and there's others out there that have these long time growing dividends. And if you're looking for the safety, that's maybe a great place to look, is for those type of companies that have been paying out dividends for 20, 30 years or more. So our examples of companies that have been doing dividends for a long time: Procter & Gamble, it makes like toothpaste and all that stuff. A lot of stuff you buy at the store. They own Gillette, which makes razors and things. They bought the Gillette company, so they own do razors and stuff like that for men's razors and women's razors. So they do a lot of products. You go to procterandgamble.com and just look at their product offerings. You'd be amazed at all the stuff they offer. So Procter & Gamble have been paying out dividends a long time. General Mills, which makes cereal and other products like Cheerios, Lucky Charms, they're making cereals. Wells Fargo, a big bank here in the United States, makes is a bank. They have hundreds and hundreds and hundreds of retail locations, plus they do mortgages and other things. So paying out dividends a long time. Company you might not be familiar with is there's a lot of utility companies out there, and that's where a lot of people go for dividends, because utility companies by law, at least in some countries, have to pay out a certain amount in dividends out and have to pay that, or they look to do that. They don't have to, I guess, but that's their main focus, is paying that out, and are known for that. So like Xcel Energy does coal but does energy. They sell energy to households and businesses through the North and Midwest of some of the western states in the United States. So they're very good there, and they are involved now in alternative energy too, like wind farms and things. Have been heavily investing in that, some nuclear energy, but a lot of it is electricity. So as a utility company, they have paid out a dividend for a long time, but during the 2008-2009, they cut their dividend, and that really impacted their stock in a negative way. And now they're back to paying dividends and been paying them pretty well. So Xcel Energy would be an example of a utility company, and then others are out there like ExxonMobil, big oil and gas company, energy companies. A lot of those will pay out pretty good dividends too, as a yield or a percentage. Once again, the stock price could go up or down at any time. How much they pay in dividends could go up and down at any time. They could stop paying a dividend at any time. So be aware, there is risk there, more risk than something like a bond or cash. They are still a stock, but they're a less risky stock than maybe like a growth stock or an undervalued stock. So if you're looking for income and maybe some growth, dividends might be, and dividend paying or income stocks might be the way to go for you.